Saving for retirement or paying down your student loan? Why not both? What's going on, everybody? I'm Danny Sinowitz, the College Dude. So today we're going to talk about how saving for retirement the right way can actually help you lower your student loan payment. There are some specifics here we want to make sure of, so let's get that out of the way first to make sure that this strategy can actually work for you. So you may or may not be aware, but you are eligible for an income-driven repayment plan if you have a federal student loan. So depending on which type of federal student loan that you have, you're eligible for one of four different types of income-driven repayment plan. If you have a Parent Plus loan, we've done a couple of videos on this prior, but you're eligible to essentially consolidate that Parent Plus loan and get into what's called the income contingent repayment plan. Out of the four income-driven repayment plans, it's the least favorable when it comes to an actual monthly payment. However, it can be better than actually just having to pay on a standard repayment schedule for Parent Plus loans. So it's better than nothing. But between now and July of 2025, you can actually utilize a strategy called the double consolidation strategy. We just did a video on that last week, so I encourage you to check that one out, linking to it here so that you have a better idea of how that works. That being said, of the four different types of repayment plans that you're eligible to enter into, all of them can be tied directly to your adjusted gross income, otherwise known as your AGI. So if you're able to lower your AGI, by default, you're able to lower your student loan payment. Depending on the type of work that you do, the more earned income that you have typically will then lead to the higher income that you have. But there are ways in which you can actually lower your adjusted gross income, but still actually benefit you. So for example, one thing that you can do is if you're contributing to a pre-tax 401k, or for government employees, if you have access to a 457 plan, which is also a pre-tax retirement account, by making contributions to these plans, it actually lowers your adjusted gross income. So a quick example, if you make $100,000 and that's what your gross income would be, if you contribute $10,000 in a year to a 401k plan, your adjusted gross income will drop by $10,000. So one of the benefits of that is obviously you are able to save for retirement. You're able to defer some of your current earnings to a future date. But one of the things that can actually benefit you greatly in the present is you're actually able to also lower your student loan payment. You see, the way that these income-driven repayment plans work is they take a look at your discretionary income. Well, your discretionary income can be lowered by lowering your adjusted gross income. There are four different types of repayment plans that are available to you. The first one is the income contingent repayment plan. That one is typically the least favorable, as we mentioned earlier, when it comes to Parent Plus loans. But whether you use a double consolidation strategy or if you have loans that are eligible for consolidation to enter into these income-driven repayment plans, such as the direct loans, the direct subsidized and the direct unsubsidized loans, you can also enter what's known as the income-based repayment plan. You can enter into the pay-as-you-earn plan, or you can enter into the revised pay-as-you-earn plan, which is actually becoming the save repayment plan, which can be very favorable for borrowers because it can allow for a much lower student loan repayment based on certain factors such as your income. In terms of actually picking which plan is right for you, you do want to take a look at what income you have. You want to take a look at your family size, your tax filing status, the amount owed, some forgiveness capabilities that you may have, along with the total amount of federal loans that your spouse has, and your overall financial planning goals. If you're able to take all of these factors and really come up with a plan, working with somebody can actually help determine which repayment plan is right for you, and more importantly, can keep you on track to lower your monthly payment, increase retirement, and help you live the lifestyle that you want to make sure that you're able to live. But one common factor across these four different repayment plans is that it is all based on that discretionary income. By lowering that AGI, you can lower your student loan payment across the board. So what are some ways in which you can lower AGI? Well, two that are available to most middle-class folks, again, number one is the actual contributions that can be made to something like a 401k plan or a 403b plan. For certain government employees, they may have what's called a 457 plan. And it's very similar in that it's a pre-tax retirement account that allows you to defer income. So if you're able to actually save for that retirement while also lowering your payment, it can be a great way to kill two birds with one stone. Another great way to save while also deferring some income is something like an HSA plan, a health savings account. So if you have a high deductible plan, you could be eligible for a health savings account. By putting money away into that health savings account, again, you're doing something very similar to the retirement plan savings. You're deferring your income and being able to then save it in a tax advantage way for potential health expenses down the road. By getting your AGI to the lowest amount possible, you are able to get your student loan repayment to the lowest amount possible. But you want to make sure by lowering your AGI that you're still getting some benefits that you would like to have, such as a higher retirement account balance, a higher health savings account balance, or overall just make sure that your financial plan is working in conjunction with your student loan repayment. No one's going to argue with the lower student loan repayment. That means it gives you opportunities to do other things. Anytime that cash flow is raised for the better, it's an opportunity that you should definitely be looking into. By working with a professional when it comes to this, you can then be in a position to make sure that your student loan payments are under control and your retirement and your future are secured. As always, this information that we talk about is meant to be educational and general in nature only. None of this information is meant to be specific advice. If you have specific questions on what we discussed today, please feel free to reach out to your financial planner, to your tax preparer, and to your attorney who helps you with this information. As always, if you found this information to be insightful, I ask that you please like and share this page and subscribe to my channel for more great content when it comes to understanding student loans and the best way to pay for college. Until next time.